Hi everyone, this is Jimmy Allen, founder and CEO of Investalytix. Let's get into it. There has been a lot of noise lately about how valuations are too high and how this rally has to be a bubble. You hear it everywhere now. CNBC, Bloomberg Terminal, Yahoo Finance, X, everyone is pushing the same narrative. But here is the thing, guys. Negativity sells. Now, psychologically, people react more strongly to pain than gain. This is how we're wired, right? So when headlines sound the alarm, it's going to grab attention, drive clicks, boost ad revenue, and that's their game. That's what they're good at. It's definitely going to help their bottom line, and it's not going to help your bottom line. For an investor like us, that constant stream, of fear they're pushing is only going to hurt decision making. And that's why I built Investalytix from the first place. We want to cut through this noise and focus only on data-driven decisions. Remember, don't trade based on emotions and headline. We need to listen to the data and let it speak for itself. Because the whole point of investing isn't just to beat others at their game, it's to control yourself at your own game. And that's how you win over time, right? Let's go ahead and head over to the chart. First, let's talk about valuation as a timing tool. So the old argument, stocks are expensive, they must fall, it just doesn't hold up anymore when you actually go test it. Now this chart from Carson Investment Research shows nearly 70 years of S&P 500 data comparing basically the S&P 500 return 12 months from now to the PE ratio giving at some point in time, right? So you got the x-axis, basically it's the market return 1 year later. And on the y-axis, you got the trailing PE. In other words, how expensive the market looked at that moment. And every dot that you see here is one point in history, a certain valuation and the return that followed. So let me give an example. Let's say the PE ratio is 25 and the return a year later is 10%. What this is saying, the PE ratio, say January of 2024, is showing 25, and a year later, which is January of 2025, is 10%. That's basically what this is saying. Here's the key stats. The R square is negative 0.01. Now, R square tells you how closely two variables or things move together. In our case, is the PE ratio and the S&P 500, performance a year later. A perfect match is 1. No relationship whatsoever is 0. So when you see a number like this example that I'm showing here, minus 0.01, it's basically saying there is no connection, no relationship whatsoever. Now that negative that you see here, it doesn't mean anything. It's just saying that the slope is tilted slightly downward, that line right here. So you can ignore the negative. I guess in plain English, what I'm trying to say, whether the market is cheap or expensive, it doesn't really help you predict where it's going next year. Time in the market, just on valuation alone is no better than flipping a coin. You're basically gambling, what I'm trying to say here. Now let's shift to the second chart. Now this one breaks down exactly what's been driving the S&P 500 return since 2019. So basically we're taking the X and now we're going under the hood, right? Which is the market return, a year later. That's what we're gonna look into. Now the market is up 125% over that stretch. But what's important, the question we gotta ask is why? Now the green part on that bar, it basically shows earning growth. That company actually making more money. The gold section is multiple growth, meaning investors, were willing to pay a higher PE. This is your bubble, if you will. We want to make sure that number is small. If that number is big, that means we got a bubble, right? And the gray portion is dividends. That's basically cash payout to shareholders. Now, if you see there's a thin black line across the top, that's the total return for each year. So when you add it all up, you get 76% of the gain actually came from profit growth. Another 19% came from dividends, and only about 30% came from multiple expansion. Again, that's your bubble. So no, this is not a bubble. This rally is powered by real business return. Companies are growing earnings and they are generating cash, and the market is actually reflecting that, right? If you found this helpful, give it a like and subscribe to the channel. It really helps us reach out more data-driven investors like you. And head over to investalytix.com, create your free account. Thank you for watching. I'll talk to you soon.